Hey guys, welcome to the Silver Gold Saver channel. Today we're going to talk about options. So everybody likes options, right? I mean, who doesn't like options? But the kind of options we're going to talk about are the financial kind. But before we do that, standard disclaimer, I'm not a financial advisor. None of this should be taken as financial advice. Please seek qualified advice from a expert, which is not me, before making any decisions. Investments can lead to losses, so please be responsible and do your homework and make your own decisions. All right, now let me introduce you to the characters we have here. This guy is Bob the Bumblebee, and he is really bullish on stocks. In fact, he's really bullish on metals as well. This guy is Sam the Stormtrooper. He is bullish, but not that bullish on stocks and on metals as well. In this example, we're going to talk about silver, and we're going to talk about options. And an option in the financial world is basically a right to buy or sell something at a certain price and a certain time. Okay, so there's two kinds, all right? So the two kinds that are typically talked about are calls, which are the right to buy something, and puts, which are the right to sell something. Now, it's important to know that there's always two sides to a transaction, right? So there's a seller and a buyer. So if somebody buys a call, then somebody has to sell a call in order for that transaction to be completed, right? Makes sense? There's always a buyer and a seller. And there's also a concept in options called a premium, and that is usually a price per contract, okay? So a premium is basically what you'll get today for selling an option, all right? So let's do an example. All right, so Bob is really bullish on silver. He's one of those guys that'll say like, silver to the moon, right? And $100 silver by the end of the year. Sam is also bullish on silver, but not quite, right? So he's just going to say like, okay, well, silver's probably going to be 30 max, but not even there by the end of the year. And so Bob says like, I'll bet you that silver's going to be 100. And in fact, I'll put my money where my mouth is. I'll pay you a premium for the right to buy silver at $30 or above. Okay, so Bob here, what he's doing effectively is buying a call. He wants to buy the right to buy something, in this case silver, at $30 by the end of the year. So we have a strike price, which is $30. We have a time period, which is by the end of the year. And then they negotiate a premium. In this case, let's just say a premium of $1 per contract, which is 100 shares. In this case, you can think of it as 100 ounces of silver. And so Bob gives Sam $100 right now. Like, here's $100, right? And then Sam says, okay, I'll take your 100 and I will wait to the end of the year or even before that and say, if silver hits $30 or more, you can exercise your option and I'll sell you a contract of 100 ounces of silver at 30. Okay, so let's do a scenario that silver goes up to not quite 100, but let's just say $35 by the end of the year. what happens? So Bob here is really happy, okay, because his option, his call is in the money, all right, meaning that he's kind of winning on that bet. So remember that he bought a call, he bought a right to buy silver at $30, even though now silver's price is above 30. It's now $35, okay? And so he exercises his right. He says, all right, Sam, give me 100 ounces of silver by right now, because I'm exercising my option right now. Give me 100 ounces of silver today at $30. And Sam is like, okay, that's fine. Here's 100 ounces of silver in the back. That's all yours, buddy. You win. So what is the result there? So Bob, okay, effectively bought the silver at $30 an ounce. So he paid Sam 30 times 100, $3,000. Okay, now he owns all this silver, 100 ounces. And then if he wants, okay, so if he wants to take profits, he can sell the silver in the market at the current market price of $35 an ounce. So 35 times 100, 3,500. He pockets a profit of $500 on that transaction, effectively because he paid $100 to Sam for the right to buy it. He pockets an effective profit of $400. All right? And Sam, on the other hand, he bought this silver a long time ago. Actually, just maybe a year or so ago, when silver was around $20. Okay? So his silver eagles were around $20 an ounce. And so even if he had to sell this 100 ounces of silver at $30, he still made a profit of $10 an ounce on 100 ounces. And he made that premium, that initial premium that Bob gave him of $100. So Sam's total profit on this transaction was 1,000 plus 100. So they both win, all right? Now the danger here is if Sam did not have the silver with him, all right? So he's actually what in the market would be called like naked in the contract, right? So he's selling a naked call option, which is dangerous, right? Because if he didn't have the silver, what Sam would effectively have to do is buy the silver at the current market price of $35 an ounce. He pays $3,500, but then he has to abide by the contract and sell that silver to Bob at $30 an ounce. So he effectively lost, $5 an ounce or $500 on 100 ounces of silver, minus the premium that he got, right? So he got $100. So he effectively lost $400. Does that make sense? Okay. So we know, and the reason I'm kind of giving this story with the characters and all is, we know in the paper markets we can't take delivery, right? And so when we play these trades in the market and options and whatnot, there's no way that you can take actual delivery of silver. But what if it can happen in the physical market amongst community members, right? So there obviously has to be a level of trust between community members. But I would say that one way to get around the question of trust is through an escrow or a custodian. So basically, what I'm trying to say is that there are members in this community that have grown in reputation. Everyone knows them. They are a trusted member of this community. They're very well known, and their reputation is extremely important. So what if Sam wants to earn a premium on his silver, right? And Bob wants to bet that silver will go higher. What if Sam gives the custodian, right, a very trusted member of this community, this guy, Paul the Pikachu. What if Sam gives Paul the 100 ounces to hold, okay, and Bob gives Paul the $100, and that transaction, that contract is sealed, right? Paul then passes on that $100 to Sam, and the contract is basically signed effectively. And if the silver price goes up to $35, Paul gives the money to Paul, or Bob, gives the money to Paul, right? Here's $3,000. I want to exercise my option. $3,000. And then Paul gives Bob the 100 ounces, and Paul passes the $3,000 to Sam. So these guys don't need to trust each other because there's an intermediary, there's a custodian. I can name a few suggestions on who might be good custodians in this community. There's a lot of them. I mean, there's a handful of them. I would say not a lot, but a handful of well-known, well-trusted community members that could make this transaction work. And of course, just backtracking a little bit, if silver never gets to 35 or even $32 an ounce, Bob doesn't need to exercise his option, right? He's not going to exercise his option at $30 because he buys it at 30, or he gets $30, but he already paid $100, so he's still down, right? So he's not going to exercise his option certainly below the strike price of 30. But the real reason I'm putting this out there is, look, there's pumpers out there, right? There's people that firmly believe that silver is going to be $100 an ounce by the end of the year, and they'll even try to pump it. They're going to be like 100 ounces is the minimum silver will reach by the end of the year. Well, why don't we just test them? I'm like, well, put your money where your mouth is, man. I'll take you on at a strike of 50, right? If I don't think silver will reach $50 an ounce, and I already own the silver, which I do, right here, 100 ounces, then I can pocket some premiums, right? Because I know that whoever's pumping the silver will never exercise the option below 50 because they're just going to lose money, right? So just food for thought. Again, not financial advice. Let me know if you think this could work. Let me know what your thoughts about this. I know one kind of common question, right, would be, well, Silver Eagles are sold in the market for like $34 already. Well, there's an easy answer to that, right? The obvious answer to that is just make the premium whatever the premium on this silver ounce, right? So be it Eagles, Maples, whatever the premium is, just make that the premium for per ounce for your 100 ounce contract. Hope this makes sense, guys. Let me know if you want me to explain further. Let me know what your thoughts are. Let me know if this could work in the community. I appreciate it, guys. Thanks again. Bye.